Hey traders, TG Watkins here. Now, I know we've got a lot of these new single stock leverage ETFs that have been coming out, making a debut, and I've been looking at some of the statistics, and a lot of money has been going into them, so a lot of people have been finding usage for them, and it's been great as long as they go up. However, there are some unknown risks that I don't think people understand and appreciate for when these things don't work out the way you think they are. You cannot hold on to these things like a normal stock. And if you do, you're going to run into some issues, which is what I want to show you in this video, because it's very important to understand how these new leverage ETFs work. I have been working with them for a long time. I made over 2,000% on an option on a leveraged ETF. So you can really leverage up on these things. You can also just do the leverage ETF itself and treat it like stock, like an equity, but you can't hold these things. That's the thing. They are not an investment. They are a short-term trade. And of course, short-term means it's relative, whether it's a day, a week, a month, or a few months. But you need to understand what you're getting into with these things. And that's what I wanted to do, is shine a little bit of light on these new products that looks like a lot of people are getting into, and I'm not sure if everybody understands the ramifications of how they work. Okay, so I'm going to be diving into some real life examples. I've been having to experience some of this stuff too, because having the single stock, yeah, I'm trading them more. So I've got some real experience that I want to share with you guys today. So today, it's the real risks of the leverage ETFs and how to fix it, because I'm sure you guys have gotten in trouble with it too. I'm underwater on a couple stocks, and I wanted to show you guys what that looks like and how we're fixing it, okay? So what is the problem? Now that there are all these single stock leverage ETFs, what's the real risk? A lot of people, if you've kind of read up on this, you've probably heard about decay. Yes, that's true. I don't think it's really decay. I think it's more like slippage, I think, is really the right term to be using for this, because decay is like an option. You got theta decay that is actually built into this. Really what's happening is that these stocks are supposed to track, or the ETFs are supposed to track the stock 2-to-1. Usually they're 2-to-1. But they're not exact. And so sometimes this is good to the upside, as you'll see in this example. Sometimes the slippage is good, because again, what they're trying to do is use derivatives to create a synthetic product that is supposed to track the stock 2-to-1. But by using these derivatives, hey, sometimes it's actually better, because they actually get more out of it, because they're using options and other products to get 2 times the leverage. However, on the way down, you can also get slippage too. So most of the time, so sometimes the slippage is good to the upside, but most of the time the risk is to the downside, and that will leave you in a hole. And that's what we're going to be talking about today. So quick answer. How do you fix this, or how do you address these things? Well, the quick answer is you limit your losses. You use a stop loss, you make sure you get out quickly, you don't hang on to these things for investments, and you make sure you don't ride yourself down, okay? Again, I'll show you some examples here of how these things look. And then the other thing, if you actually find yourself hanging on to some of these things, you must trade your way out, because you cannot, you most likely will not be getting your money back if you just hang on to them because of the slippage. They won't come back to where you were, or if they do, it's going to take a very, very long time. So if you find yourself in a hole, you're going to have to do something about it, okay? Since this is going to be on YouTube and a bunch of other places, hey, these are new products. Comment if you've been having troubles with these, and let me know what your experiences are like, okay? I'm actually kind of curious to see what other people have been doing, because, as I said, there's a lot of usage out there, a lot of money going into these things, and I want to see what you guys have done too. So please leave a comment with me on X, something like that. Let me know, what have you guys found out? Any kind of tips or tricks? Like, what do you think about my video here, and how you've been experiencing this kind of stuff? Okay. So a little refresher, stock market math. This is just stock market stuff 101. Doesn't even matter if it's leverage ETFs. Stock market math does not work in your favor. If you lose 50% on a position, that means you have to make 100% just to get to break even. So, how hard is this, or how much do we actually look at positions and be like, man, that's amazing, I made 100%. And again, this is not options. This is just stock. So how incredible is it when you're like, man, I made 100% on a stock? How often does that happen? How often do stocks go up 100% at a time? Maybe not very often, right? And so if you lose 50% on a position, you now have to make 100% to get that thing back, just to break even, okay? And this is a really good chart here. And you can see that basically the more you go down, the more you have to earn to get it back just to break even. And again, 10% down, look how much more you have to get. It kind of goes exponential. So it's really important that you minimize your losses. And when it comes to these leverage ETFs, it's even more important because of the slippage factor. These things don't come back right to where they were. They just don't. Now, there is a little bit of magic and beauty into this because the leverage ETFs, when they do go up, they can go up a lot. But you have to be active about this. You have to be proactive. And that's what I'm going to show you guys here. Okay, so here's the first example. This is ETHU versus ETHE, basically the leverage ETF of Ethereum and just the regular ETF of Ethereum. Now, I know this looks busy, so let me just kind of dive into this real quick to show you guys some quick things about this. So here is the leverage ETF. And these are the same charts, same daily charts. And what I did is I took just kind of an early situation here. Let me actually use green just so we can change colors. So right there is where I'm going to have the start. And let's say you go all the way down to the bottom. That's an 85% loss on this particular move with the leverage ETF. It's a 55% loss on the regular. Now, again, I know these numbers are not exactly 2 to 1. That's the point. There is leverage involved. These things do not track perfectly. You'll also see on the way up, they may not track perfectly either. Apparently, and again, I'm just doing this based on what I think on Thinkorswim. You go from the bottom to the top, 540% gain from the bottom and top, based on a 190% gain for the ETF. Obviously, that's not 2 to 1. As I said, there's slippage in here. Sometimes it's in your favor, sometimes it's not, okay? This is what we have to work with, so I'm using these numbers. So we have that, and then what I decided to do is to show you guys how you're going to have to actively work to get yourself out of this hole is, let's say you're going to have to trade, okay? Here's a first move, 175%, okay. And then let's say there's another move right here, 200%. Okay, good. Now we have our parameters that we can work with. You can also see you have 70% here, 85% here for a total of 190 as far as this particular move. Now, these same concepts that I'm telling you guys about for these leverage ETFs and how to dig yourself out of a hole is true for regular stocks too. I mean, if you lose 55% on a big move, well, essentially it's called dollar cost averaging. But if you can figure out where the low is and add more to your trade and come back, you will be able to make your money back quicker or your investment break even quicker if you can figure out where to buy the dip. Okay, essentially this is just a big story on how to buy the dip, but how to do it with these leverage ETFs because the leverage cuts both ways, good and bad. Okay, so this is the example we're going to be using for these examples. Now, I know there's more math in here, bear with me, it's going to make sense. Let's assume for this example, you took a bigger trade. So I'm going to have a bigger trade and a smaller trade. You put a big trade on here, $100,000. Okay, now if you take a zero off if you want it to be smaller, whatever. You put on $100,000 and the stock went down 80%. Now you have $20,000. And you're like, man, I really dug a big hole. I put a lot of money on this thing. I don't have a lot of money to put on, but I got to put something on. Okay, because if you look, remember, you went down 85%. And Ethereum, actually, let me go back here because I forgot to kind of mention this real quick. This is the important thing. What you'll notice is from the starting point here, you'll notice that Ethereum at its peak actually went up. It actually went higher than your original entry, which was a 32% gain. So if you did nothing with the non-leveraged ETF and it made new highs, great. You're actually doing okay. You're now up 32% if you just held and did nothing. However, if you did the leverage ETF and you bought here and you did nothing, you just held onto it, you would be back at break even when the Ethereum ETF is plus 32%. There's your slippage. There's 32% slippage on the way down to the way back up. You have to actually make new highs in the non-levered ETF just to break even for the levered ETF. That is the problem, okay? So now if that's the problem, we have to figure out how to address this. So we come over here and you say $100,000 minus 80%, you now have $20,000. And you can't just hang on to this because you most likely won't make your money back, okay? And so I said, okay, let's say this was a big trade and you're gonna just put some more money back on it. Let's just say you put $20,000 back onto this. Okay, now remember, you're putting $20,000 onto this thing at the bottom and you're gonna make this first move. This first move on Ethereum happened to be 175%. Great. That's $35,000 profit. And now you're only down 40,000 on your original 100,000. So you add that together, you now have $75,000 out of your $100,000. Not too bad. You actually dug yourself out of a pretty big hole pretty quickly, but you're still down, okay? You are short of your original investment. Okay. So then what you do is, as you look through this and you're saying, okay, I got to keep trading, let's say that was one trade. That $175 was one trade. You took it off and now you're still there. You still have your original 100,000 that you haven't touched. So the next trade, you put another $20,000 on, and you can see here the next move on Ethereum is 200%, or ETHU is 200%. That's $40,000. You are now back to break even on your original investment. You add the 40,000 to your now 100,000 break even. Now you're $140,000 positive. Fantastic. That's awesome. And I think I actually forgot to add the 35%, the 35,000 here. So you'd actually be up even more. Okay. So this is actually working out pretty well. You now have your money back. You've made your break even on your original, and now you're profitable on your other trade. And that actually beats the 32% on the regular Ethereum non-levered ETF. Okay. So that's one way to do it. Let's take a look at another one. Now let's just say you didn't load the boat on this trade right at the top. It's just another trade. It's a percentage of your account. And you got plenty of cash, plenty of dry powder to work with. So let's just say this was a $20,000 trade and you lost 80%. You now have $4,000 left. Not great. Okay. But you have plenty of money to work with. It's just a trade. And let's just say you just decided to throw another trade on it, and your trade size happens to be 20,000. So basically you just threw on you doubled your position size on this. You go up 175%. That's $35,000 in profit. Then you have your $8,000 left from your original. That equals $43,000. So in this first trade off of the low, you are now profitable by $13,000 even from your original 20,000. Okay. So this is great. The first move up, you are actually now green. And this is kind of the example to show you that, it's part of the reason why, number one, you don't want to load the boat and put everything into one trade. That happens with stocks and options and anything. You want to make sure that your risk is diversified. And this is also another reason why you want to make sure that you still have some dry powder to work with. Because if you're out of money and you can't put more money on this trade, then you're not going to be able to make your money back. Okay, so this is really another good example of why you just don't want to throw everything at one particular trade. Make sure you have something to work with. Okay, so then let's say the next one. You just put on another trade, which happens to be another $20,000. You make 200%, it's $40,000. You are now break even on your original 20,000, okay? Plus the 40,000, that's $60,000. Plus the profit from the original one, and now you have $75,000 of profit on top of your original $20,000 that you put into it. So this is awesome, okay? This is really awesome. You just made a bunch of money, even though you pretty much did a terrible trade on the way down, but because you were able to double the trade, or at least put another trade on, and then you were able to put another trade on, you were actually able to take advantage of the benefits of these leverage ETFs on the way up. Okay, so it's very important to be doing that. And that is definitely compared to if you just held the regular Ethereum ETF, you only have 32% up. Okay, now this one's even simpler. And I thought, I don't know if this example is happening all the time. Like, I think it's pretty crazy that the leverage ETF of Ethereum actually went 540%, even though the regular Ethereum only went like 190%. Obviously, there's some big slippage here. So this might be a unique situation, but I think it's just one more thing to kind of look at. So let's just say, again, you had your $100,000, you lost 80%, you're down to 20,000. Okay, now again, you added your 20,000 at the bottom and you just let it ride. Okay, so this was 540% that happened to go up. You made $108,000 of profit. You are back to break even, because remember, we're coming all the way back up here. You're back to break even on your 100,000. And so that means you are now up $200,000. You made $108,000 on top of getting to break even. So you made $108,000 on top of breaking even. That is awesome. So really, the moral of the story here is that if you happen to find yourself in a really big hole on these leverage ETFs and you're at the bottom, you need to find a way to add more funds at the bottom and be able to ride that up, okay? Because you are not going to be able to get back to break even very easily on these things. It's going to take a long time, and you're going to need that underlying stock to really outperform in order to even get back to break even. So it's critical to add at the bottom to figure out where that is, all right? Here's another situation. If you have 20,000 and you lose the 80,000 or 80%, you're down to 4,000. And let's say, yeah, you just put another trade on. You just doubled up, 540%. $108,000 plus your break even, you're now up $108,000 on top of your original $20,000. Incredible. Absolutely incredible. Okay. So this kind of shows you the power of the math that works for these leverage ETFs, but you have to figure out where to add at the bottom in order to move this up. All right. Now I will continue to talk about some risks later in this this video to show you that I'm kind of showing you the best case scenario. Like you're finding the exact bottom and this thing moves up a lot. I got some more things to kind of talk to you guys about. Now let's take a different example. I'm not going to run as much math, but this is just to show you Tesla, okay? Here is TSLL. It's the 2X leverage ETF of Tesla. And you can see with Tesla, and we're taking this as the original example, and you can see Tesla made its way back. I'm gonna assume here, not necessarily the pullback, but I'm just going to say the high water mark. You can see up here it was 8% positive. So if you just held on to this whole thing and didn't do anything about it, you eventually got your money back and you're actually plus 8%. However, if you held on to TSLL and did nothing about it, you are down 25%. Look at the difference from where this was right here, where they both started. And because they went down and came back up, the leverage ETF, due to slippage or decay, whatever you want to call it, did not make its way back up. It is 25% down compared to 8% up, okay? Kind of crazy, I know. However, the power of being able to find the low and actually trade your way out of this situation is powerful. So you lose 75%, just kind of similar to the Ethereum examples that I showed you. Here's a 125% move. Awesome, okay? You can do a lot of good with a 125% move to dig yourself out of a hole. And then you look, there's another 100% move. Again, you can do pretty well digging yourself out of a hole here. Now, maybe if you didn't take those two trades, it's still 200% from the lows. So if you lost 75% and you simply added at the lows, you could be up then 200%, which obviously gets you back mostly gets back your 75% loss and then some on top because of that 200%. So again, for these leverage ETFs, if you find yourself in a hole at the bottom, you absolutely need to trade your way out of it if you are holding the bag on something like this, okay? And just to show you, here's 55 and 45% for a 100% move from bottom to top as far as just the non-leveraged ETF. So even if you find yourself in a hole with the non-levered ETF, you can take the same approach and same idea of adding somewhere at the bottom in order to help offset these things and get yourself back to break even or positive if these things work. Now, here's the risk, okay? This is why, obviously, what I showed you is if everything works out your way. The risk is if you add on the way down, okay? Because in these examples, I said we found the bottom and we managed to take the entire run to the upside. Perfect situation, right? What if you don't know where the bottom is and you keep buying the bottom? You keep buying these dips and it just keeps on dipping. Okay, you're digging yourself in a bigger hole. Okay, so it is kind of important to be careful and know how to trade these things and actually know what an uptrend is and make sure that you're not buying on the way down. Make sure you wait and make sure you wait until these things actually start to turn up to figure out that you aren't just buying on the way down. That's important too. Now, the other risk, stock never actually recovers, okay? You keep buying, maybe it trades, maybe it goes up a little bit, comes back down, it just falls apart, company doesn't do well. There's still risk, okay? I showed you examples of where these stocks recovered pretty nicely. What if the stock never recovers? It's a dud of a stock, okay? Then there's really not much to work with, all right? That's another situation. Or what if you just poor trade locations? What if the stock is messy? What if you're not really great at trading? What if you can't find these spots and you're just backwards on these trades every time? Every time you buy in, it goes down, or every time you sell, it goes up. Things like that. Poor trade location chops you up. So even though you're trying to fix your situation, you can make it worse because you're just chopping yourself up with this stuff, okay? So that's a problem too. Now, like options, the leverage ETFs are terrible on the way down. but they're absolutely incredible on the way up. And I think if we just understand the new product that we're dealing with, we can work with it, okay? The easy short part of the story is just trade these things on the way up. Do not hold them too long. But I know that's not reality, okay? If this is exactly as easy as I say it is or we think it is, we'd all be rich and we wouldn't ever find ourselves in a problem or in a hole, okay? I am in a hole on a couple trades and I'm going through the math and I'm looking at this and I'm gonna figure out a way to get out of this. And that's the whole point of what I'm doing here is I wanna tell you guys, reality, well, sometimes we get stuck in some trades. It's not great. We should have rules. We should follow them, but sometimes it just doesn't happen. Okay, so this is what's important in order to do that. Now, if you guys are interested, as I said, I'm pretty active in trading these things. I think the market has pulled back a lot. I know this is going to be a timeless piece, but when you find that the market actually comes down quite a bit, yes, you might find yourself stuck. Hopefully your stop worked, but you need to know how to get yourself out of these things. And that's what I'm going to be doing, teaching and showing this stuff every day that I'm in the room. I'm live on the mic every single day. And these are the things that I talk about. And I hope this was beneficial to you, especially for how many people and how much money is coming into these leverage ETFs. So come into the Moxie Master Room. We have $7 trials for 30 days, simplertrading.com/Moxie. Hope to see you guys there and hope you're surviving and doing well with these new fangled leverage ETF, single stock, crazy situations that we have, right? New products out there. Hope you're doing well with them. We'll see you again soon. Take care.